and make volatility great.
And it's all good.
Have a great show.
Sleepless nights now these days with this kind of volatility. I mean, intra night you can make a ton of money.
Oh my God!
Dude, 100-point move in this.
Charlie, don't go down that road, buddy. You're too old and accomplished to be trading in the middle of the night futures. That's a difficult life. I tried that when I was young.
I'm addicted. You always
wake up every second hour and you're like, what are the futures doing? What are the futures doing? But you basically have somebody who's got a matrix-like control over your brain.
Yeah, I'm an addict. I will admit, I was up at 10.
At least you're honest. That's the most important thing.
ISM looks strong, Charlie. ISM just came out.
Yeah, I just saw that. There you go.
What's that?
I said ISM just came out. Looks strong.
Oh, okay.
52.6.
Well, there is no doubt there's an attempt to run this economy high.
Wait, Charlie, what was this? Charlie, what was this metals reserve thing that Trump said? What the hell is that?
Okay. Yeah, I was actually going to talk about that.
All right, let's save it. Save it for the show.
Because Robert Friedland is involved in that thing.
Oh, Bob. All right.
And that's Ivanhoe Electric, which is up 9% this morning.
Yeah, Charlie, you're pretty dark. You think you need a little light in your
No, I'm the Prince of Darkness these days. This is my dark mode.
That's part of his.
Yeah.
That's part of his look, Ben.
Who is that guy that was considered the Prince of Darkness and a trader?
Prince of Darkness?
Yeah, he was.
Ozzy Osbourne.
Ah, yes, Ozzy Osbourne.
No. This is a trader that worked under.
Good call, Jen. Though that was the correct
that's
call.
what I get that's what I get for chiming in. I'll let you guys focus on the market.
It was a good one, though. That was a good one.
All right, you guys retweeted. You guys ready to go?
Retweeted and loaded. Let's go.
Retweeted, loaded, ready to go. Welcome to Wall Street Beats, everybody. I'm Steve Lamar, joined by
Charlie.
Benjamin Bry. What's that?
We lost Charlie. What happened to Charlie?
We lost Charlie.
I'm here.
The Prince of Darkness.
Okay. We got Charlie. We got the Prince of Darkness. Oh my God, it's so dark.
Prince of Darkness, Charlie Peabody.
Charlie, you need some light over there, bro. There it is.
And we've got Benjamin Bry, our macro pro, and we're going to make volatility great again, if you hadn't noticed by looking at our hats this morning. So, Ben, what do you make of this move overnight? My goodness, down 100 bips or 100 points on the SPOOs, and all the commodities were getting crushed, and Japan was not looking pretty at the open, and here we are, back to even.
Yeah, I mean...
Like it never happened.
I mean, I left Dubai at 2 a.m. Sunday morning, and then I got to New York at 8 a.m. Sunday morning, a 16-hour flight, and then I flew to LA, and then I woke up at 1:30 at night last night, Monday morning. So my sleep's a bit off, but I did wake up and see what was going on, and you had all the precious metals at the lows. You had Asian open pretty ugly, and SPOOs were down almost 100 bips, and I think it was like the veracity of the deleveraging in the precious metal space, especially. But just in general on Friday, there's some carryover. Some guys who in Asia get margin calls and forced selling in the morning. If you remember Liberation Day, guys remember Liberation Day. So you had a really ugly Wednesday night, really ugly Thursday, really ugly Friday. Then we come in and limit down Sunday night. That then rallied a little bit over the night, and then one last dump where all the force guys were selling, and then that was kind of the low. We retested the low in SPOOs, but there was some stuff that never retested that deleveraging low of that Monday morning. Sometimes that happens, and let's be clear. I was talking to Charlie from the airport in Dubai on Saturday night, or whatever, and we were talking about we both were short silver, and that was an all-timer, right? That was an all-timer trade. Minus 38% in 24 hours is. I think I looked it up, and someone said it was the largest silver move since 1792, when America was a young 16 years old. So, that's
So
that
was
was
I.
what that was the trade that I was warning Bakes and everyone on here about for a while, that I got into a little early in December, then exited, then got back involved in mid-December, and then got really big in the like earlier this week, end of last week, and then covered almost all of it on Friday when silver was at 76 and SLV was at 71.70. And thinking, we had a discussion about this of like, oh, should we keep it? And when you use options, time matters, right? So I think that this is an answer to your question, where the built up leverage gets delevered. The guys who are short, who are using leverage, they cover because they're like, hey, I don't want to wait. My expiration date is in 2 weeks. I don't want to dick around and have it then rally back to 85, which it did. Then it dumped back to 70, and then it went to 88. So it's chopping around in
Yeah.
$13 increments, which is crazy because Charlie can attest. First time I ever got involved with silver, it was $6 per ounce. Now we're moving $10, $12 intraday, right? Like, but Charlie, what did I see this morning about the metals reserve? Somebody texted me that, and like I said,
Yeah,
excuse me, my sleep is a little bit messy here as I move
yeah.
12 time zones.
Yeah, so the Trump administration announced, well, actually, it wasn't announced, it was leaked, that they are working with a number of large US corporations like Stellantis and Boeing and General Motors. In fact, I think Trump is meeting with Mary Barra today. And then there are some trading houses in there, and then there are some miners. Robert Friedland, who owns Ivanhoe Electric, which is one of the names I've been recommending. In fact, I think that Ivanhoe Electric is up 9% this morning. Um, so they're going to create a special reserve similar to the SPR for energy, but in critical minerals, so that we have at least what I think it's a 2-year supply of metals, of critical metals like cobalt and gallium and copper and U.S. Some of the rare earth stocks are up big this morning on this news as well. So yeah, I think it's a strategic metals reserve, similar to energy, that Trump is working on with some very, very large, established players in corporate America. And it seems to have covered, as I said, buyers, the miners, the traders, et cetera. So I suspect it's going to come into fruition. The one area that I didn't see, and I'm looking at my screen, and the two, areas. There's a lot of red on my screen, but the two areas where there's green is in financials and in materials, and I would think that uranium has to be part of this critical reserve. I haven't seen what the uranium stocks are doing this morning. Have you been at all? Let's see. Where
I can look. Hang on.
but
Got
they're all red. The uranium stocks are red, but I would think that's, if we're getting a bid in some of these other material stocks like rare earths and copper, and I would think uranium somewhere has to be part of that strategic effort. So I'd be buying the uranium stocks on this weakness.
Which ones, Charlie?
uh,
Do you have a favorite?
URNM is, a
So just
basket of,
the ETF. Yeah.
yeah. I mean, the institutions all go and buy Cameco because it's the most liquid. So
Right.
that's your institutional play. Um, I'm buying the physical uranium. So I own Sprott, the Sprott Trust, SRUUF. I also own Yellowcake, by the way, out of London, YCA. But I like the uranium play here, on this news.
Okay.
Um,
How about the I saw your note this weekend that came out about financials topping, and is there, if you have to be in, Charlie, is there a place to hide in financials?
Yeah, I mean, I'm long some of these regionals like U.S. Bancorp and M&T. I'm not looking to make a lot of money the way I did in the precious metals, but I think they can, the regional banks can be solid performers. Against that, I'm short private equity, and I'm now starting to add, and I've tried this twice already, and it hasn't worked. So caveat emptor. But I'm adding to my shorts, the large money center and investment banks. And the reason I say caveat emptor is because the news right now, the fundamental news right now, is very, very positive. But the enthusiasm around that is also at all-time highs.
Right.
And they're priced for perfection. So if our hats are any indication of what the increased volatility, particularly if it's bad volatility, is going to make it very difficult for these capital market stocks to execute on the pipeline that they have out there. And we've got some really big deals already in the works right now. I mean, J.P. Morgan is out trying to syndicate Electronic Arts, which they took down. They did a bought deal, $20 billion of that debt. I believe Wells Fargo and J.P. Morgan are also trying to do the Sealed Air deal right now. So if we get bad volatility, and that's an important if, but if we get a bad volatility, we're going to have hung loans out there.
Yep.
There's also talk, from what I'm hearing, that is it OpenAI that's in the process of trying to raise money, that the reception is
Well,
not very
they're
good.
perpetually trying to raise money because they're perpetually burning money.
Yeah,
Just
but I'm
saying.
hearing that there's what I'm hearing is there's resistance now.
Yeah,
Right.
that stuff from out of Nvidia came out that it's funny because if you just rewind back to September, I was saying that to everyone. I remember I came back from St. Bart's and Mike Green had kind of laid out what was going on in Meta, and I was telling Steve and everyone, hey, these things are going to go into the debt-funded portion of the capex boom now, and the market realized that after the fact, right? And because in September we were getting these circular announcements, like the Oracle one that sent the stock up to 340, only for it to lose 60% from there. Meta re-rated its equity. Although it came back from the lows, but CoreWeave got cut in half, and so the market realized it. All the CDS priced up. Recently, it's come down. They've come in a little bit. Some of them, not Oracle though. So Oracle's clearly being forced to do stuff, and I think it came out that they're going to have to cut 30,000 people, or do a raise. I mean, like, look, it's classic capital markets analysis. You have a few levers, right, Charlie? You have the lever of cutting spending. You have the lever of raising equity. You have the lever of raising debt. Now, if you look at Oracle's credit spreads, they've gone from 45 basis points to 160 roughly. And that's not the debt market closing them out, but it's definitely much more expensive debt than it was before. And so, I don't know. They're clearly deciding to go the trend of all tech, which is firing people. I mean, tech space is really on a job cutting cycle right here. I think Amazon just cut 16,000 a week ago or something right before earnings. And
Well, they had to in order to fund the documentary.
But Ben, all these stocks re-rated higher multiple times with these circular deals, and now Jensen just pulled the football from Lucy. So were any of them real? I mean,
well, I think that if you look, for example, at like a SoftBank, right? That's another one where they had promised a lot, and what was real is maybe not what they promised.
right.
And it was working for a while where you just announce these things and then the equity would rip. But again, let's all remember, if we learn anything from Bitcoin going from 126,000 in early October to currently 78,000, or silver going from $46 in Thanksgiving to a high of $121, only to fall to $70 in 24 hours, is that price is not. I know it's ridiculous to even
Just
say that, isn't
crazy.
it? Like $50 move, 50 ounce or $50 an ounce move
it's
in
insane
24
to even
hours.
hear it.
Steve,
Yeah.
by the way, Charlie, Steve texted me privately, and he's like, how many guys went out of business today?
Well, and I agree with that. I was about to say, if you look at these capital markets, banks, their prime brokerage book has just ballooned in the last 12 months, absolutely ballooned. And so they definitely have growing counterparty exposure. And, I've highlighted that, in JP Morgan's 10K, they talk about the risk of a lot of their clients would be hurt if silver, squeezed higher. So somebody got hurt in that squeeze, and obviously the unwind may be occurring right as we speak. Um, but that I want to finish up on the financials and why I'm looking at shorting, the money centers and investment banks. If you look at the XLF index, which is the broad financial services index, that has literally gone nowhere since last fall of 25. It's been trading in a very tight range, 52, 56, that range. It tried to do a prairie dog high on January 6th and failed, and that to me was important. Um, and then if you look at the underlying components of that XLF index, um, the drag has been insurance stocks. And I will remind you that insurance stocks actually let us down during the great financial crisis. Go back to May, June of 2007, and you'll see the insurance stocks peaked first, way before the banks peaked, and they started down. And I think we're seeing the same sort of erosion here in the insurance stocks. Same thing with private equity, private debt, although they weren't prevalent back in 2007. But they have been a drag on the XLF index. Same with the payment stocks, like PayPal, and then more recently, obviously, with the potential 10% cap on credit cards, those stocks have started into a distribution phase. So the only thing that's holding up the XLF index right now are these large cap banks. It's the money center banks, the investment banks, and the regional banks. And I think we're starting to see, we're going to see, I should say, we haven't seen it yet. We're going to see some wear and tear in the first half of this year in those names. And so I think by, May, June, we're going to see a collapse in the XLF index. Obviously, the leverage way to play it, and Ben has talked about this in the past, is FAZ. Now, that can lose value over time because of how it's structured. But that's
it's a trading vehicle, right? Like, I mean,
yeah,
you're giving that out as, hey, here's a less sophisticated way to do it, basically. But yeah, it's an inverse product. Inverse product is a product that's tied to an underlying spot product. You're going to have a natural decay from that, and you're short the carry on replicating that. So the cost of carry on these things are anywhere from 8 to 14% a year, which means is what Charlie's trying to warn you about. That's not a holding security. That's a trading security.
Is it just a 1x or is it a 2x levered, or how did they structure
1x, I believe.
It's just
that's just a 1x. So you don't have the rate of decay is like a double, or I don't think they do triple anymore, or maybe they brought them back. I can't remember, but it's definitely not as like a double. Just go ahead, Charlie. Sorry.
Yeah, no, I was going to end there. I just think that the asymmetric opportunity in being short these money center banks. I mean, JP Morgan is trading at 3 times tangible book. It's just not something I've seen in my career, and I've been around for 45 years. Um, you know, and so the bull case is that they're going to get re-rated higher because of deregulation. Well, my counter argument to that is this is a pay-to-play administration, and this administration is going to turn around and ask these institutions to do something that I personally don't think is going to be constructive for their returns. And obviously the 10% cap on credit cards is one example. But I also think, when you look at the different line items, in this industry, the first thing that jumps out to me is the banking industry is over earning on credit. I mean, we have not had a credit cycle in a long, long time. And, we've seen a normalization of credit losses on the consumer side to the point that they're now at normal, but they're not anywhere near stressed. And we're just beginning to see a normalization on the corporate credit side. And to me, that's the most important thing, is that we've had now 5 quarters in a row where corporate non-performing assets have been rising quarter over quarter. Very consistent rise in corporate non-performing assets. So I think the credit cycle is coming. It's been, frustrating, if you will, in waiting for it to develop more visibly. But you see it in the private equity, in the BDCs. Now you're starting to see it more consistently in the banks, clearly off of very low levels. So it's levels that can be managed, and the banks are well reserved. But this corporate credit cycle is emerging, and if it does, we've got a spread widening trade ahead of us, and that's going to be disruptive
Yeah.
to markets as well.
As the panelist who owns the ass load of CDS here, I can agree with that. Um, and just saying, like that's
Been
my
a
view as well.
painful
And I
carry,
bet,
painful cost of carry.
yeah, that is the problem with that. But I was talking about this on my podcast last week with Mike Green, who also is a poor bastard who owns CDS, but he at least owns the underlying, and so he's making the spread. He's just hedging it. But he was showing a chart that shows bankruptcies are higher now than in 2001, and that excludes the workouts. Which, by the way, if anyone's close to this, know there's a lot of workouts and extend and pretend going on, and so. I do think it's coming. I do think when you look around, you just see a lot of stress. I mean, think about Caesars, for example. Caesars is a company that has way too much leverage. Its underlying fundamentals are not very good, and so it took a lot of price. I think there was a lot of companies that took a lot of price to offset organic weakness. When I say organic, I mean volumes, visitations, widgets sold, whatever you want to say. And I think that we've hit the maximum price pushing on a while ago. And to use the Caesars example, he even mentioned that. Apparently, they're selling $25 1 liter bottles of water in Vegas. I mean, $25 for 1 liter of water? What are we doing here? You know what I
$10
mean? Like,
for a Starbucks.
yeah,
No
exactly.
joke.
And look, I think Starbucks is a good example too. They tried to do the same thing. Chipotle, they push price. Now they're not as good examples for this credit discussion because they're both decent credits. But the point is that they all try to do the same thing. Some people have relatively stronger positions than others, but the big problem is that your expenses keep coming, and I think that everyone who I talk to that talks about inflation doesn't understand that like we can have cost pressure and not inflation, and then the valve that like resolves that is margins, because you have to remember margins are a piece of the cost structure unless the government's producing, right, which they're not producing much. So it's guys who sell to the government then sell to you, they have some margin built in. And the private sector clearly has margin built in. So if your metals prices are going up, or your costs of labor are going up, or whatever, your eggs. You remember last year everyone was talking about goddamn eggs. Eggs went down 75% since then.
Yeah,
Things have a
round
way of
trip.
resolving themselves. Silver went down 40% in a day. Like commodities, I'm very hesitant to ever think of commodities as something you should worry about as inflation. I think that they have their own cycles, which are based in supply and demand. And lumber in 2020, do you remember that? Or cocoa a year ago, all up in the right, and then boom, they did the Mackey. Our partner Jeff Mackey coined the term the Christmas tree of death, and they tend to all do that. So I think we sit here at a weird time where it's like we have near high all time S&P. Some economic indicators, as Charlie said, the ISM was highest since 2022 today. There's a couple, demand indicators from earnings so far of stocks that did better. Even that Starbucks did a positive 4% U.S. comps. It's been years since they've done a positive comp. Years. I mean, that's like
Yeah.
many quarters since they had a positive comp. So there's things that you can lean on to say, hey, and Charlie and I were talking. Robert Half was at the COVID low. Some of these consumer stocks were at the COVID low. So you can have a credit cycle even if you see some improvement from some of those things, just because it's about refinancing more than it is about the hey, we're not as bad as we were. Would you agree with that, Charlie?
Yeah, and I would say, while I've been trying to play some of these deep cyclicals on the idea of a run hot economy, to me right now they're trades. They're not they may turn out to be investments, but if I see any faltering in this effort, because let's say long-term rates head back up to 5% on the 10-year, that's going to stifle the efforts to bring back housing and things that are important to the economy. Ben, the one last thing I wanted to mention about, I was going down the path of talking about how earnings are looking very, very healthy, but we're over earning on a number of areas like capital markets or credit or whatever. And so, on one valuation metric, the banks are incredibly expensive, and that's price to book. 3 times tangible book is just not something I see in my career. But on another metric, they're only trading at 12 times earnings, and that's relatively cheap, 55% of the market multiple. But that 12 multiple is based on earnings estimates that are going to be up 17% on average next year. And I have a number of companies that are looking to grow earnings per share by 27%. So there, you get any faltering in one of the metrics, the line items in the P&L, and that PE multiple is not going to look so attractive. And that's what I think we're facing with these capital markets names, that there is an incredible overenthusiasm about the pipeline that's out there. And yet the environment to execute is becoming more difficult, I think, or will become more difficult. So I'll send it there.
Charlie, how does this
Um,
square with your view on Citi? Are you
Well,
still?
yeah, I mean, I still, on a relative basis, like Citi. Our famed technician, Bakes, who's done a great job of keeping me in names, because I tend to get out too early, still thinks 140, 150 on Citi is a reasonable target. I have them earning about $10.30 this year. So relative to the group, they're cheap. They're, trading 11 times.
Right. So
So
they might
yeah,
not trade down. If the group trades down, these guys might not trade down as much.
as much. Yeah. I mean, they'll
Yeah.
trade down with the group, but not as
Yeah.
much. And I do think book value is solid. So now you start talking about tangible book, for them is $97. So $100 is probably a good place to buy it again.
Okay. So Ben, any follow up thoughts on that NVIDIA idea from what was it, a week ago? You sticking with it?
well, yeah, I mean, I'm not changing like based
You're not
on.
changing.
I mean,
Okay.
no, I mean, I think if anything, look at what we saw. I don't remember what day that was, but the stock is flat. I think it was 188.50 or something when I said that, and it's 188.74. I just checked. Um, we saw Microsoft commit to an enormous amount of spending, which the street didn't love, and and
You
maybe
could say that.
maybe Azure decelerated a little bit, but that quarter, the larger takeaway on the Microsoft thing was, and by the way, I'm glad I recommended NVIDIA, not Microsoft, is inelastic markets. That quarter shouldn't lead to an 11% $440 billion market cap decline. I think you
No.
guys would agree with that, right? So, and unlike $1 billion of flows in the post pre-market, it's just that's such a huge inelasticity, that it's just kind of the same as silver. What happened to silver? What happened to gold? I mean, gold 1200 dollar move from Thursday morning over in Asia time to last night low was, I think, 4500 or 4400 or something. Like, that's just,
Crazy.
what are we doing? But easy come easy go, as they say. Regarding Nvidia, I just think that Meta agreed to a lot of spend, Microsoft agreed to a lot of spend, and then you see Oracle and Amazon both cutting people in in favor of investing in machines. So I think that's kind of the trend. I think there will be a compute oversupply. I don't know if it's 6 months or if it's 15 months, but like, I think a year from now we could be looking at it, because I come back to being upfront with all the what's going on with architecture changes and some of this stuff. I think we're kind of getting close to peak compute demand per unit, if you will. And
Yep.
and so, but for the now, I think it's okay. I think it's still, they're gonna hum along. They'll have a good quarter. that not that that's mattered. They've had a lot of good quarters that don't then trade well. If you guys remember the last one where we had the good quarter and then everything dumped the next day. Although to be fair, that dumping was the low before we got the most recent 2+ month rally. But yeah, I don't have anything monumental on it other than sticking with it.
Before we go, Steve, I just want to mention one event or data point. February 10th, we have a banking conference. Typically, you don't get a lot of good updates because the banks just reported things in mid-January. But if there was some unusual, volatility in the markets between now and February 10th, we could see, some news announcements at that February 10th. So just keep that on the calendar. We could get some updates on fundamental events on February 10th.
And before we go, I wanted to ask you both: what are your thoughts, or what are you guys hearing about this new Fed chair? I'm hearing people are concerned about him being hawkish, if that's possible with Trump in office.
I mean, I would tell you that SOFR rate, like my H7s went up 10 basis points since he got announced, so that wouldn't say that,
No, that's for sure.
I think that what he wants to do is lower rates, lower balance sheet.
Shrink balance sheet,
that's
right?
Yeah, which is why Rocket Mortgage got absolutely, that game where you hit the moles, you hit the moles, the mole donk, or
The whack-a-moles.
I'm an idiot. Whack-a-mole.
Yeah.
Thank you. Sorry, I've been traveling around the world and my brain isn't fully there. Whack-a-mole. They whack-a-moled Rocket Mortgage and that stuff last week after that. And I think that's what it is, right, Charlie? Like he's kind of been a proponent of smaller balance sheet.
Very much so, and we discussed this on Friday, Steve. When you asked me about it, but yeah, I think he was chosen, and I think Stephen Mirren and Stephen Miller were sort of the voices, in Trump's head saying, Warsh fits our desire to radicalize how the Fed operates, and I think that's the most important thing, that the Fed is going to operate in a very different mode. To me, there are two important takeaways to that. One is the Fed put may no longer be there. And I think that's what we saw overnight in that 100-point drop. And that's a very important thing. And then the second, obviously, is what Ben talked about, and that is they all want a reduced footprint of the Fed in capital markets. And that's why I'm playing the volatility and potentially bad volatility in capital markets right now.
That's why we got these red hats on.
Exactly.
All right. All right, let's wrap it up there, boys. Anything else you want to talk about before we go?
Nope.
No, I think that's it. Let's call it.
Let's do it.
Keep it right on. Keep it tight.
Keep it right at 7:30. All right. Have a great day, everybody. Follow us on wallstreetbeats.com. Thank you, Ben Bry. Thank you, Charlie Peabody. We'll see you back here tomorrow.
Have a good day, guys.
Thanks, guys.
Have a great day.
Yep. Thanks, Jen.
Guys.
Thanks, Jen.